What advice do you have for crypto investors?
Do you mean retail investors or institutional? I think my advice would be very different to those two groups.
It's a good question. Let's just go with both. I would love to hear what you have to say for both.
Okay, I would say with retail, crypto is a very risky, very volatile asset space. You do want to be in it longer term, but be aware that these 80% drawdowns are happening and are likely to happen for the foreseeable future. So position sizing is the most important thing you need to worry about. If things get really tough, can I survive this? Don't put on too big a position, and definitely do not put on leverage. Retail investors tend to get in trouble with too much leverage on their positions. Okay. But longer term, I mean, crypto is very likely to be around for a long time, and learning about it is best done by trading and being active in the market. So, be there and trade it, but keep it small enough that you can afford the pain of the downturn, similar to what we're seeing today. For institutional investor, my advice is slightly different. I would still say you should be experimenting in this market. For you guys, the interesting thing is the infrastructure for trading that's being built in crypto markets is, I would say, 100 years ahead of what's in the traditional markets that you are used to. The efficiency and effectiveness of the trading platforms is going to absolutely steamroll the traditional trading venues. And I would recommend to sort of start learning about how things work there so that when it happens, you'll be prepared. I'll give you an example, sort of the huge difference between traditional infrastructure and the crypto infrastructure. In traditional infrastructure, let's say you trade futures. And the way, let's say you're trading futures on wheat, for example. So you have to put up a margin. And okay, at the end of each day, your position is marked to market. And the exchange calculates any additional margin that's needed. And you have until the next morning to come up with the cash to keep the position.
Right.
In that period between the calculation of the margin and depositing of the cash, the exchange is at risk. Right. If you actually go bankrupt, the exchange may not be able to collect, and they have a fund to kind of insure them against that. But it is a real business risk for the exchange, which is why they set the margins very high. To sort of live with having that risk on their balance sheet. So the size of the margin is a function of the payment cycle and the settlement cycle. In traditional finance, the settlement cycle has to be at least 24 hours because the traditional payment rails take 24 hours to get your payment from your bank to the exchange or the broker and settle it. So by nature, they cannot offer high leverage in the products that they trade, just because of the settlement counterparty risk issue. You go to crypto exchanges and you realize that they recalculate the margins at a much higher frequency. The exchange I mentioned, BitMEX, actually, they started recalculating margin on every tick. So every trade happens, they go through 1 million accounts that they have and recalculate the margin requirements immediately. So they don't have that 24-hour sort of delay for them to be at risk. They can liquidate positions much faster than that. Because of that, they can lower their margin requirements. And some of these guys used to offer 100 times leverage. I mean, thankfully, they sort of reduced that now, but you can still get 20 to 25 times leverage on your crypto positions. The exchanges can afford to do that without putting themselves at risk because of this much faster settlement cycle that they have available. Now, if you are an institutional trader and you're doing things like hedging, you're doing things like arbitrage, where do you want to execute? You obviously want to execute at the place with lower margin requirements because you'll have a better capital efficiency. You'll have a higher return on capital. So liquidity is likely to stay at these crypto exchanges that have the newer technology. And we're seeing that clearly in, for example, the Bitcoin futures market. CME rolled out their Bitcoin futures product in, December 2017, right? So it's 4 years now. And they only have about 5% market share in global Bitcoin futures trading. which is amazing. I mean, CME is a leading venue for derivatives trading. How come they cannot get more market share than that? And the response is because of how slow their settlement cycle is, they are requiring 35% margin for any Bitcoin position, while the crypto exchanges are doing, they may ask for 3 to 5% margin for the same position. So again, as an institutional investor, you'll be better off trading on these new style exchanges. Now, these guys, the crypto exchanges, are coming into the U.S. So right now there is a hearing in front of the Congress Senate Agriculture Committee, and there is a application with the CFTC in which FTX, which is one of the leading crypto exchanges, is trying to bring this 24/7 trading in commodities with instant margin calculation and instant settlement. So T+0 seconds. If this gets approved, and really there's no reason why it shouldn't be, it needs to work its way through the regulatory process. But if this gets approved and you will get a fully regulated exchange with these parameters, I mean, can you imagine what that's going to do to people like CME? Their technology is completely unprepared for competition with this sort of competitor.